Missed Nvidia's tenfold surge? The second wave of AI appreciation is here. Where is this opportunity? How to invest with confidence? Hello everyone, this is Michael's Fortune Bread, your guide to US stocks. Have you regretted missing Nvidia's tenfold surge? Are you feeling clueless about the next disruptive opportunity? In this video, Michael uses objective data to reveal the hidden investment opportunities in the AI wave. Over the past 2 years, AI has undoubtedly been the most significant investment opportunity in the US stock market. But who really benefited? Besides Nvidia, there are very few companies that have achieved transformative changes. Even Nvidia is now entering a stable period after reaping the first wave of AI benefits. At this point, after in-depth research on the recent AI sector, I have discovered that a new category of opportunities within the AI concept is likely to emerge soon. It has not yet fully materialized but has shown impressive explosiveness in certain areas. Unlike the first wave of AI hype, this new opportunity will not be limited to a few companies like Nvidia, but will be broader and stronger. If you miss the first wave with Nvidia, you cannot afford to miss this second wave of AI appreciation. In this video, Michael will combine the latest industry data to uncover the new opportunities in this AI wave. Let's see which companies will benefit and how we should plan our investments. Disruptive technologies like AI follow certain patterns in their development, from the electricity revolution a century ago to the internet revolution in the 1990s. They typically go through 3 stages, each with distinct investment opportunities. Let's take the well-known internet revolution as an example. The first stage occurred in the late 1980s to early 1990s, during the initial rise of the internet. The most beneficial companies were foundational hardware companies like Cisco, which made network routers and switches, and Intel, which made chips. The second stage was in the first half of the 1990s, when internet applications for businesses started emerging, including email, instant messaging, customer management software, and supply chain management software, mainly aimed at optimizing business efficiency. The third stage occurred in the late 1990s, when various consumer-facing killer applications began to explode, such as Amazon, PayPal, and Yahoo, which emerged during that period. Similarly, we see the same pattern in the current AI technology revolution. The foundational wave of AI appreciation has clearly arrived, represented by Nvidia. Now, as the first wave stabilizes, the question is, when will the second wave of appreciation in the B-side applications arrive? Many ordinary people feel that current AI applications are limited to chat software like ChatGPT, with no real killer applications yet. Some believe AI investment is still premature, considering most current trends as bubbles. Indeed, consumer-facing applications will take a long time to mature. But on the business side, applications have already been widely deployed, with significant results in certain areas, though ordinary people might not feel it yet. As investors, we must be more sensitive because changes in businesses will be the most critical aspect of the second wave of the AI tide. Narrator, VO. According to Bank of America, software companies top the list of sectors most benefiting from the generative AI wave. By examining the financial reports of multiple software companies especially those with skyrocketing reports this season. I found some intriguing clues. For example, comparing the gross margin and EBITDA of Shopify, Salesforce, and ServiceNow. Gross margin reflects the product competitiveness of software companies, while EBITDA reflects operational efficiency, showing how well a company can use limited resources to generate more money. This capability is a typical scenario for AI applications in businesses aimed at reducing costs and increasing efficiency. These companies have seen good improvements in their EBITDA in the last 2 quarters despite stable gross margins. The data suggests AI's effectiveness in business cost reduction and efficiency enhancement, which the management of these companies has confirmed. Shopify's management mentioned using AI internally to improve efficiency and productivity across almost all departments, including engineering, sales, and finance. Salesforce launched an AI application called Einstein internally to handle low-value, repetitive tasks, saving employees a total of 50,000 hours in the first quarter. ServiceNow's management stated that AI applications have increased data extraction speed by 53% and report analysis and view list extraction speed by 27 times. These operational efficiency improvements have boosted the stock prices of these companies, with Shopify rising 30% after the earnings report, ServiceNow up 15%, and Salesforce up 30% since the last quarter's report. Thus, we see the initial spark of AI applications on the business side. Narrator, VO. But I am not stopping here. Let's dig deeper into this trend to see if there are any more subtle signals. The software companies mentioned primarily optimize operations through internal AI use. But are there software companies that can provide cost reduction and efficiency services to others while benefiting themselves? Yes, there are. Snowflake, a company providing data analytics platforms to businesses, has gone all in on AI under its new CEO this year, aiming to achieve better sales and operational outcomes through AI-level data analytics. The best metric for their business performance is the RPO, representing the long-term contract amount. This quarter, their RPO saw a significant increase, from 5.2 billion to 5.7 billion, attributed to AI's impact on their operations. Snowflake's stock surged 30% after the earnings report. ServiceNow, mentioned earlier, also has a similar nature, providing a digital workflow platform to optimize business efficiency. With AI, ServiceNow's RPO grew 26% this quarter, the fastest growth in a year. Palantir, a big data analytics company, belongs to this category, providing business optimization solutions through data analysis. Since launching its AI platform, Palantir's RPO has consistently grown over 40% per quarter, leading to nearly quadrupling their stock price in the past year. Of course, I have highlighted some software companies performing well in cost reduction and efficiency enhancement through AI. However, many software companies still struggle for reasons we will discuss later. Not all companies show such performance. These are exceptional cases. Some may wonder why AI's cost reduction and efficiency enhancement initially appear in software companies and why they begin to explode at this point. The reason lies in the inherent nature of software companies, where the best AI application scenario is to assist programmers in coding. GitHub Copilot, launched by Microsoft, has increased programming efficiency by 55%. Additionally, these software companies have the capability to develop and customize AI software internally, gaining first mover advantage. This customization trend is known as small language models. In Morgan Stanley's report, Leveraging AI to Drive Efficiency, AI-driven cost reduction and efficiency are divided into 3 stages. Generic AI tools like ChatGPT, customized models accessing specific company data, and AI assistants evolving into agents. The small language models we discuss fall into the second stage, tailored for specific tasks and solving privacy compliance issues. Over the past year, large software companies like Microsoft, Salesforce, and Intuit have launched their small language models. This trend is still growing. We are witnessing the early stages of these models' emergence, with a long upward cycle ahead, meaning AI-driven cost reduction and efficiency improvements and benefiting companies are likely to start a concentrated, sustained explosion. On a side note, some companies have begun developing the third stage of AI agents, such as Palantir, while companies in the second stage are also aiming for AI agents, foreseeing a broader future market. As Nvidia's CEO Jensen Huang recently said, AI agents will bring a new wave of appreciation. However, our current focus is on the trend of AI-driven cost reduction and efficiency enhancement. All right. We've seen some initial signals of AI-driven cost reduction and efficiency improvements in software companies. So, how will this trend develop in the future? This question is critical as it will determine how we should structure our investments. First, I believe that software companies will continue to be the main battleground for AI applications in B-end, business side uses. This trend is just beginning, with plenty of growth potential ahead. Don't think that the recent jumps in a few companies' stock prices mark the peak of this appreciation wave. In fact, they are not even the starting point, but merely a signal. Despite the impressive bull market in US stocks over the past 2 years, software companies as a whole have been under pressure. This is primarily because the pandemic in recent years led to a surge in irrational software demand, causing many software companies to expand irrationally. However, as the pandemic subsided and macroeconomic pressures like interest rate hikes increased, software company revenues began to slow down, while costs became too high, leading to low efficiency. This is why we saw massive layoffs in software companies last year. Currently, software companies are not entirely out of the woods, but fortunately the problems they face align perfectly with the issues AI-driven cost reduction and efficiency improvements aim to address. AI applications for enterprises face no competition and limited technical barriers. As long as companies have development capabilities, they can achieve cost reduction and efficiency improvements in specific areas. Even if some companies lead while others lag, this trend will spread across enterprises, ultimately benefiting valuations as costs decrease and profits increase. Therefore, we are likely to see a broad appreciation period for software companies, where most can benefit from this trend. The trend's universality will be strong, especially given the high concentration of funds in the US stock market. If software companies broadly benefit, this could lead to significant rotational effects and even some speculation. However, AI-driven cost reduction and efficiency improvements also have a downside. Because they face no competition, they cannot create new competitive advantages for enterprises. Moreover, The benefits are mostly one-time, as costs cannot be reduced indefinitely, and efficiency cannot always be improved. The bonus period is limited. Market participants often overlook this, seeing profit growth and assuming it will continue indefinitely. This sentiment can lead to local overvaluation and bubbles, requiring investors to be particularly cautious. Due to this risk, I believe a period of differentiation will follow the broad appreciation period. Just like in the first stage of AI appreciation, foundational companies like Nvidia and AMD saw broad appreciation, but at some point, companies that failed to establish competitive advantages like AMD began to lag. Ultimately, Nvidia was the only one that continued to benefit. A similar differentiation will occur in the B-end applications of the second wave of AI appreciation. Only a few companies will likely emerge as winners, while many others will become mediocre. So, what characteristics will these successful companies have? While I cannot predict accurately, I believe these companies must possess several key traits. 1, they must continuously build competitive advantages and sustain growth through AI. 2, they must have high-quality private data, as models built on public data do not have enough competitive advantage. 3, they must have flexible and replicable business models. For example, pay-per-use models are more advantageous than headcount-based models, and SaaS platforms are more advantageous than consulting platforms. 4, their management teams must be high quality with strong execution capabilities. For those of you eager to jump into the action, it's important to remember a crucial risk. When discussing opportunities, we must look beyond the individual points and consider the overall trend and context. The same stone placed at the top of a mountain or at the base has very different potential energy. The companies we analyze now are just points in the development of AI. So, what is the overarching trend? It is the trend of AI-driven cost reduction and efficiency improvements in B-end, business-side applications. Currently, this trend is just beginning. Any application companies emerging now carry high risks over a longer period. Remember, in the internet revolution, the early application companies like Netscape and America Online didn't last. This is an inherent uncertainty in the technology development stage that can't be resolved just through analysis and prediction. So, no matter how exciting a company looks now, as investors, we must be prepared for the possibility that it might not succeed in the long run. Therefore, we should never go all in on any company, no matter how promising it seems. Lastly, I want to discuss how we as investors should invest in this second wave of AI appreciation. The first step in understanding how to invest is to look at valuations. Overall, the valuation of software stocks is not too expensive right now. The current average EV over sales is only 8 times, much lower than the average of the past 5 years. Even if we pick the 5 most expensive stocks, they are still at relatively low levels. Of course, this is the overall situation, and there are some exceptions, such as Palantir, whose valuation has already skyrocketed. We won't analyze individual stocks here. Earlier, we mentioned that software stocks will remain the main battleground for AI applications in B-end business side uses, and we are likely to see a broad appreciation period soon. During this phase, if you do not have a favorite software stock, investing in ETFs like IGV or ARKK could be a good choice. These ETFs are worthy of consideration. If you plan to choose individual stocks, you can look at the ranking of companies with the highest R&D investment ratios. Theoretically, companies with higher R&D investments have more room for AI-driven cost reduction and efficiency improvements. Companies like Unity, Team, Datadog, Confluent, and Roblox have high R&D investments. This is just a reference, and specific investments should not rely on a single indicator. I believe that if you want to invest in individual stocks, you must have a long-term vision and a clear understanding of risks. Over the long term, differentiation will occur in this cycle. When selecting stocks, you should focus on finding the ultimate winners rather than being swayed by the current broad appreciation trend. At the same time, you must be prepared for the possibility that even seemingly promising companies might not succeed. Finally, I must also mention foundational companies. Today, we have been talking about the second stage of B-end applications, and it might seem like the foundational companies are no longer relevant. Please don't be mistaken. The explosion of B-end applications will certainly promote the development of foundational companies. And this is highly certain. Foundational companies do not face the high valuation risks during broad appreciation or the disruptive risks during differentiation phases. They will consistently benefit. Therefore, from an investment perspective, they remain the most stable choice for AI investment. That's all for today's video. Thank you for watching and see you next time.